Welcome to Investors Guide. You're watching ET Now. I'm Faye D'Souza. Thank you so much for joining us. On this show, we're going to help you wade through what might seem like a really volatile and scary stock market. We're going to tell you what you should be doing at a time like this, whether or not you should worry about your mutual funds or any of your other investments, and we'll also give you advice that you can apply to your portfolio. We'll start off by helping a young investor, create a strategy that will achieve all of his goals over the next 30 years. In our product review, we look at the HDFC Growth Fund, and we'll help you plan for your daughter's future. It's time for me to bring in Dhirendra Kumar, the CEO of Value Research. Dhirendra, thank you so much for joining us, especially in a market like this. And we're getting a lot of questions from worried investors. Now, we saw the stock market take a continuous beating over the course of the week. There have been a lot of things that have supposedly gone wrong. Corporate numbers have not been great. We're in an earnings season. There's some concern about Greece and about China. And this would not be the first or the last time, perhaps. And of course, there's also some sort of information now that our monsoon might not be ideal this year either. So for a retail investor, whether I'm holding stocks directly or I'm holding equity mutual funds, it might seem like a worrying time. What's your recommendation on what we should do?
We have seen 2008, we have seen 2002. Markets didn't go up for a long time. I think, compared to those days, I think we are in a reasonably positive frame of mind. Yes, these are noisy times. Everybody is worried. The worry might be, might be valid. The reason for individual worries being referred might be valid. Earnings growth may not materialize of a scale, or companies are not growing as fast as possible, as expected. But all these things don't matter if you are investing for next 5 years, if you are investing for next 10 years, and if you are investing out of your savings regularly for next 5-10 years. In fact, these are great opportunities. You are buying cheap, and it would have been bad if market was going up and remained at an elevated level, because you would not be able to buy it, for any long-term investor. And long-term investors should only consider equity. Short-term investor, I don't think equity market is the place for them. If you are investing for any short-term goals, so if you are investing for 5 years, 10 years time, then it'll be ideal if the market remained depressed, very low, very disappointing for all those years till you are investing, and is up only at the time when you need your money. And if that is few years, but that may not happen. It is extremely difficult to predict even that. So the only thing you can do is average your investment, be on a methodical plan. You have to really, all these things are not in your control. What is in your control is your time frame and your discipline, and I think most investors should follow that.
All right. In fact, if you've been one of those people who've written to us over the last 1 year saying, oh God, the market has run up and I haven't started an investment, is it too late to start? Well, there you go. Here's your opportunity. Now is when you should start. And the rules remain the same. Only invest in equity if you have at least 5 years on hand. If you have 10 or 20 years, even better. And the fundamental rule of investing in equity is an SIP, an SIP, an SIP. Do it systematically. Do not put in a lump sum. And if you have questions about your portfolio, you can write to us. Our email ID is at the bottom of your screen. You can reach me personally on Twitter as well. One such investor has written to us in our portfolio segment. Well, 33-year-old Vikayat Bansal has written in Dhirendra. He takes home 1.35 lakh rupees a month. He's unmarried. He tells us his parents don't depend on him and their insurance is looked after. He has a home loan that he pays and monthly expenses of about 25,000 rupees. But it does seem like he saves a fair amount of money. He has term insurance. He's planning to increase that to 2 crore rupees. He has health insurance provided by his employer. And he's sent us a quick note saying he's going to buy one of his own as well. 1 lakh rupees going into PPF. And apart from that, he wants to add 50,000 rupees to the NPS this financial year. Interesting goals. He'd like to build an emergency fund. He wants to save for his own wedding. He's planning, to save for his child, for the childbirth, for the child's education. For 2 children, he wants to put aside 2 crore rupees and his own retirement. So here's a young man who's planned out the rest of his life and he wants to make sure that he's financially ready for all of it. It does seem like he's thinking quite methodically about it, Dhirendra. Anything in particular you would like to point out about his portfolio before we talk about his mutual fund specifically? Does it seem like his portfolio is on track and he is someone who's thinking quite clearly about how he wants to manage his money?
A person in his age, I think he should get his allocation right. His PPF is a very long-term investment. He should not be making that big allocation. at least the biggest change I would suggest him is, he should stop his PPF or just keep his PPF account live, make the minimum annual contribution to it. Remaining money he should invest in the ELSS. He should invest in ELSS to the extent that he can save tax under Section 80C. He plans to increase it, and these funds which he has chosen is good, but he may not necessarily need so many funds. By having some broad, the whole objective of buying funds should be that you are able to get, you are able to invest in proven vehicles, proven investments, and get a broad diversification. But I think this, adding few more funds may not necessarily be a meaningful thing.
He's actually written to us, and he's obviously someone who watches the show on a regular basis, saying, I'm sure you're going to tell me that 9 funds are one too many, but I want to have 3 different portfolios for my 3 different goals, which is why I've picked so many different funds. Even so, Dhirendra, even if he has 3 different portfolios, 9 funds, plus the fact that he's planning to add a mid and a small cap fund to that portfolio, that would take the total up to 10 funds. That's still one too many, isn't it?
No, 4 or 5 fund is good enough, and maybe 9 might create a problem of manageability, keeping track of it, and particularly the small and mid cap fund, when you pick them, you are able to look at their performance in isolation. The problem is that when you are faced with a 3-year or 4-year of lean period, that is a time when you will miss out, when you will actually lose your patience, you will get anxious about it. And that is when it creates a problem. If you are faced with a situation that, a situation like as recent as 2008, in any of these small and mid-cap funds, you will find that, they were down in value, by nearly 80-85%. Your 100 rupee gets down to 20 rupee. And that's the time when most people panic. It's extremely difficult, to manage your emotions. When you are in a diversified vehicle where you can't really look at things in a segregated way, you tend to hang on. You tend to still have that belief. So, and that is what diversification delivers you. When you get into narrower vehicles, they are more volatile, and they were performing. Till about a week or 2 weeks back, everybody was asking us best small and mid-cap funds to buy. I think people will stop asking that, because we will see the other side of it now. So keep that in mind, that it is extremely important to follow a method and have your universe in a manner that you retain your belief, you follow, because in a very long period of time, when you look at it in on a 10-year, 15-year, 20-year time frame, the difference will not be much, will not be very significant. In a brief period of time, it might look different. Last 1 year, when we see the return, the large cap and the large and mid cap fund, they might be delivering 60%, 45%. Compare that with small and mid cap fund, which will be up 100%. But what we are missing out is the lagging performance of the same same funds in the previous years, and they are just playing catch up.
Well, Dhirendra, if we look at his portfolio right now, he has picked funds that we've recommended on the show. There's HDFC Equity, iPro Discovery, UTI Midcap, Birla Sun Life Equity, Reliance Equity Opportunities, and IDFC Premier Equity. Now, if you want him to bring it down to 4 or 5 of these funds, given his long-term goals, which ones would you like him to hold on to?
I would like him to hold on to all the mainstream fund, which also has reasonable mid-cap allocations. So I would like him to hold HDFC Equity, ICICI Pru Value Discovery. Maybe I can give up on the UTI Midcap Fund, though it's an outstanding fund. It has done very well. Maybe Birla Sun Life Equity Fund, another mainstream fund, likewise Reliance Equity Opportunity. So I would like him to carry on with what he already has, these 4 or 5 prominent funds in his portfolio.
All right, so Vikyat, here's the advice that you're getting. You need to reduce the amount going into your PPF right now, because you're a young man, you don't have to invest that much money in debt. Now, as far as your mutual funds are concerned, Dhirendra, they're giving you a list that you can work with, bring that down. And of course, like you promised me, health insurance, that's not your employer's, a higher life insurance cover, and of course, an emergency fund. And if you need anything else at all, write to us. Email ID is at the bottom of your screen. Dhirendra, Pankaj Gupta has written in. He's 63 years old. Now, he tells us that most of his investments right now are in short-term debt funds with about a 3-year horizon. He doesn't need any sort of regular income. That's looked after. He's a little worried about the reducing interest rates. He says, with the fact that interest rates are coming down, should I be moving my money out of my short-term debt fund into an income fund. Would that be a better thing to do? And would you recommend some income funds for him? Now, the reason why we've picked this question is because there'll be a lot of retired viewers who are possibly watching at this point thinking, if I am on a fixed income and the interest rates are coming down, what should I do right now to make sure that I strategize properly? So for someone like Pankaj, what would you recommend he does?
Yes, this could be one of the temporary solutions. Short-term rates, short-term bond fund will be yielding lower as interest rates come down. But at the same time, there'll be a one-time opportunity. When interest rates go down, the long-term bonds go up in value, and that is where the dynamic bond fund or the income funds invest. So next 2-3 years, if we see a declining interest rate, they will be a key beneficiary of fall in interest rates. But beyond that, they will also stop earning higher return as interest rates stabilize at lower levels, and that is a problem for all the retirees. That is a time where that is the reason why everybody should also have, because fixed income is unlikely to beat inflation, and as inflation comes down, interest rates will come down, and at a certain level, my sense is that individuals savers inflation or need for income from their investment will not go down to the extent. The inflation will go down. So from that standpoint, the income from fixed income will put a lot of retirees in strain. And the only way to supplement it on a long-term basis is that this is your long-term money. You do not depend on it for income on a regular basis. Have a small part of it into equity. That's a real asset, and the way to get that equity exposure so that this is the age when you are most apprehensive, you are risk averse, and you'll be extremely disappointed. So get into a conservative vehicle. Get into a vehicle where in a staggered way. At the same time, have a small allocation. Maybe 10-15% of your money should move into equity if you have sizable money into fixed income, because on a long-term basis, my sense is that that's the only way to insulate yourself from preventing your money or helping your money protect its value.
Welcome back. You're watching Investors Guide in ET Now. Thank you for staying with us. Dhirendra Kumar is on the other end of the line in Delhi answering our questions, and we're going to have him review the HDFC Growth Fund for us. But like always, Avan is here to give us some information about that fund, and then we'll come back and talk about it. Avan.
Thanks for that, Faye. Under the scanner this week is the HDFC Growth Fund. The fund was launched 15 years ago and has given an annualized return of nearly 20% ever since then. While the performance isn't disappointing, it pales in comparison to the other funds in the same category. Fund manager Srinivas Rao Ravuri, who took charge of this fund in April 2006, combines a top-down and bottom-up approach. This means he will take short-term pain for long-term gain. Apart from avoiding areas of the market that he considers expensive, the fund manager will also back his best ideas with conviction. While over a 10-year period, the fund's returns have matched the category average, it also means it is an average performer in the middle of the pack. Does this performance merit your money and time? Let's find out. With that, it's back to you, Faye.
All right, Avan, thank you for that information. The HDFC Growth Fund, unlike the rest of the funds in that particular basket, has not done well maybe for the last 3 years now. It's sort of middle of the pack. It barely manages to beat its category average. What's going wrong with this fund? And for any investor who's still invested in this fund, would you recommend it's time to call it quits?
Yes, HDFC Growth has been a disappointing fund. It is a fairly old fund. In fact, this was the original HDFC fund, because all other funds which we refer to, the HDFC Equity or Prudence, and so they are actually erstwhile Zurich fund and managed by the same fund manager for a long time. So despite this fund has been a struggle in the last 3 years, it has not been able to beat its benchmark. It has very much, even on longer time period, it has been a below average performer compared to its peers. It has been more volatile and delivered less return compared to its peers. And peers meaning the large and mid-cap category, which is a fairly broad category, large number of funds in this. And I think it can be attributed to many of its bets not going right in recent years. And so it has been disappointing for a while now. And it is anyway not a very mainstream fund. It is not a very popular fund relative to most other equity funds that we see around. Yeah, but yes, I still feel that 1,000 crore here in a relatively, and last 3 years it does not justify its expense. 2.5% expense, the way it has gone up, and just to match the index is fairly disappointing.
Well, Dinendra, the last time we talked about this fund, you gave it 3 stars. Would you continue to give it 3 stars at this point?
No, I think given by the way it has performed since then, I think it has. I would say that 3 star will mean being average. I think it has been a fairly below average fund, and I will slot it where its risk-adjusted rating takes it, which is 2 star.
All right, 2 stars there for the HDFC Growth Fund and Investors Guide. Remember, Dinendra saying that it might make sense to move out of that fund if you're still in it. There are plenty of other options within the same fund house itself. And of course, those options you'll hear about on this show. It's time for us now to move on to our hold or sell segment. Well, Paramjeet Patnaik has written in, Dinendra, 22 years old, young man. He has a target to have a nice chunk of cash in his bank account when he's 35 years old. So he has 13 years to go. And he's putting aside a fair amount of money. He's already saved about 6.5 lakh rupees. And he wants to continue these investments. He wants to know if his portfolio, as it is right now, is on track. Now, he has funds from Reliance, from HDFC, and from Quantum, and he has 2 tax-saving funds. So there's Reliance Equity Opportunities, the Tax Saver, and the Retirement Fund, which is a young fund. I'm not sure why he has it. His HDFC Balanced and Mid-Cap Opportunities, and Quantum Long-Term Equity, and the Quantum Tax Saving Fund. So if you were to look at his whole portfolio, Dinendra, holistically, what of these funds you would like him to hold on to, and which ones would you like him to exit? Let's take a look at the tax-saving funds first. Would you like him to hold on to both of those funds?
Yes. In fact, when I look at all the funds, he has chosen an excellent fund. These funds in combination will help him accumulate and grow his money substantially. And even his he's so young, 22-year-old. So even if he's targeting that he needs sizable amount of accumulation and growth till when he's 35, that is still 13 years away. So he's well on his way to he will only get positive surprises with his disciplined savings. But I think he should just bring in some method to his approach. One is that generally avoid, if you're disciplined about your savings and if you're investing in equity for the long term, that is your retirement plan if you don't lay your hands on it. So, and the most important thing which he should keep in mind is that first avail your Section 80C. That to my mind is the first thing which an investor should do. One, you put your money into equity which will grow in a nice way. The other is that tax saved is money earned at the outset. So that is something which he should use to the hilt, and then plan things accordingly. His Reliance Tax Saver and Quantum Tax Saving Fund, these 2 funds, he should increase his allocation to the tune that he will be saving taxes. And after that, if he has appetite for risk, then just have 2 more funds, maybe, and he can do without that balanced fund. He can do without the retirement plan. And maybe, he should just have this, HDFC Mid-Cap Opportunity and Quantum Long-Term Saving Fund, Long-Term Equity Fund. These 2 funds in combination will do the job for him. It will also be simplified, and he will be clear in his mind what he's achieving with this.
Welcome back. You're watching Investors Guide on ET Now. Thank you for staying with us. We've brought in Gajendra Kothari to answer the questions you had about asset allocation. Gajendra, thank you for joining us. Our first question comes in from Abhishek Mishra. Abhishek has a 6-month-old daughter and he'd like to plan for her future. He wants to create 2 different corpuses, 1.5 crore rupees for her education and 10 crore rupees for her wedding. Well, Abhishek, I'm actually curious to know why you think her wedding is going to cost close to 10 times more than her education, and why the planning has been made in that manner. But that aside, if we take a combined goal of 11.5 crore rupees for your daughter's future, which would arise in about 25 years, Gajendra, how would you like him to invest that money?
You want to have a corpus of 1.5 crore for your education goal and 10 crores for your marriage goal. Now, assuming a return of 12% and on a monthly basis you can invest, you need to put in roughly around 23,000 rupees per month towards your education goal. And you should choose just one fund to invest into this goal. And again, the fund would be something like large cap diversified equity fund, which is very consistent, conservative, and you can consider investing in Birla Sun Life Frontline Equity Fund. For your marriage goal, which is 25 years down the line, and you want 10 crores, you need to invest 53,000 rupees per month for next 25 years, and again at 12% you can expect 10 crores. You can consider investing in Mirae Asset India Opportunities Fund, and all you need to do is just remain invested over this time frame, and I'm sure you'll be comfortably able to achieve the goal.
Our next question comes in from Abdul, who's 32 years old, and he has a very interesting question. He wants to know if it's possible to create a corpus of 5 crore rupees by investing aggressively in mutual funds over the next 20 years. Well, Abdul, I've been spending the last 7 years telling you that of course it's possible. Gajendra will help you decide exactly how much you need to be putting aside every month starting today. Gajendra.
Just to give an idea, if you want 5 crores in nominal value, which means without taking inflation into account, then it's very simple. You need to invest roughly around 50,000 rupees per month, and again, as I said, 12% return would easily be able to help you achieve the goal. But if you want 5 crore adjusted to inflation, which means the value of 5 crore today, what will be the value 20 years down the line? At 7% inflation, it will be a whopping figure of 19.32 crores. Now, if you need to achieve this corpus, then you need to put in 2 lakh rupees a month in SIP every month going, and assuming 12% return you are getting is what will give you 5 crores after 20 years.
All right, that's a wrap on Investors Guide. Thank you so much for watching. Remember, if you have a question for any of us, send it to us on our email ID, or reach me on Twitter, or reach me on Facebook. Gajendra, thank you for answering our questions this week. Thank you so much for watching.